Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about, are we in a stock market bubble? It sure feels like we are. And so is it going to burst or is this an opportunity? Today I'm going to be talking with you about how did we get here? What's going on? What is the dilemma? What are the similarities between now and 2000 when we had that tech bubble burst and everybody was panicking? And this is much larger than that period of time. I mean, it's not even close. So rightly so, some people are nervous, and I think it's because you're reflecting back on 2000. So I'm going to be sharing with you exactly what's going on in the market, what's driving this, what are the areas of concern that I have for my clients. If for those of you who are new to the channel, I'm David Aaron. I'm an investment advisor working with clients right across Canada. I do planning for my clients, and I also manage their investment accounts. So I've got 25 years of managing money. And today I'm going to be sharing with you what I'm concerned about, and maybe you might be too, and what you can do about it. Okay, so let's get into today's video. Put your comments below. Strap into your chair because it's going to be a deep dive into some really important information for you. Okay, so let's get into today's video. Here is the year-to-date chart as of the end of the business day, October 7th. This is the North American markets. You can see, surprisingly, if you're not following the markets, Canada is beating all of the US indices. So Canada right now is about 22% year to date rate of return. NASDAQ 18.5%. The S&P 500 in blue is about 14.5%, and the Dow Jones about 10%. Now, what's really, I think, unnerved a lot of people is you look at where we came from in the beginning of the year. We're much lower, and then we went down seriously in April. What's significant about April is that was when Trump introduced tariffs to the world, and that caused a lot of panicking by governments, companies, like who's going to pay the tariff, how are we going to be able to afford these, or is this going to be translated to the consumer at the end of the day? If you're invested in some of these companies, does that mean like it's going to do well, or are they going to have a poor balance sheet? Is the stock going to drop? There was a lot of unknown situation in the market, and so it caused a lot of panic, and you saw what's going on. Now all of a sudden we go from what was really a bear market to reaching all-time highs in the span of the same year. That's freaking out a lot of people, rightly so. But I'm going to share with you what's different about right now as compared to 2000. And I hope I've got enough evidence to show with you what is significantly different. Okay, well, what's driving the market? It's the AI invasion of not only the S&P 500, but the Dow Jones and the NASDAQ. 10 companies make up 70% of the S&P 500 right now. You can see on the right-hand side all the names of those big companies. You're using many of these companies already. Most people have an Apple product. And if you're using a computer, or if you've got some data centers, NVIDIA is in there with their chips. Microsoft, Amazon, Alphabet, Tesla is in there. Meta. These are all dominating the market, and you're using many of those things, and will likely continue to use those companies as well. Now, the other thing, despite the U.S. government in shutdown right now, which is not uncommon, it's happened before, but not to the extent of how many days. Like in the Reagan years, it was 1 day, 2 day, that kind of thing. And then we got into a few days where it might have been 5 or 6 days. Right now we're seeing in the previous administration that Trump, when he was in, the longest shutdown lasted 35 days. So he's not new to this. He's very comfortable in this environment, and he seems to think that there's some strategy involved in that, but it really doesn't translate to a whole lot of discomfort in the market. They know that the government cannot continue to be in this position, and will have to resolve that in a fairly quick manner, so it doesn't really translate to long-term problems for us. And so what you see is it's represented in the VIX. For those of you who don't know what the VIX is, the VIX is an index that tracks really investor sentiment around anxiety of the markets, volatility of the markets. And you can see here in April, look at that big spike. That's that black line in April when Trump introduced the tariffs. So you can see that people were unnerved. the VIX goes up, and it's representing a lot of worry in the market. And you can see, actually, I'll blow this part up here for you, but you can see there was a decline, and that was in the previous chart. So rightly so, people were unnerved by it. So how do you know about the VIX, whether or not it is representing a lot of anxiety or not? Anything above 30, so the VIX is a measurement, anything above the 30 mark is starting to get people kind of worried about the market. And you start seeing them move out of equities into the bond market, into gold. We see gold reaching all-time highs, into cash positions. When the VIX is below 20, as it is right now, I think it's about 17, we see people full on into equity markets, really like not worried at all, not really wanting to be in fixed income, and just go all in on the equities. And given the fact that you see these technology stocks soaring, people are trying to take advantage of that. People who have maybe long-term horizons, and people who have a risk tolerance that supports them being in it, they don't mind being in that. Okay, the other thing that is supporting the markets going up is the unemployment rate. And now you say, why would that help? Well, when jobs are being lost, the government starts to lower interest rates. We lost 66,000 jobs in August in Canada, and that was the second back-to-back month decline since 2021. So you see the unemployment rate is at 7%. In Ontario, I think it's around 11 or 12%. But that's the unemployment in Canada. When unemployment spikes, interest rates are usually, you see some interest rate reductions. So that's kind of supporting this idea that the market, through interest rate reductions, is going to go forward. Now, the other part of, and that's just not in Canada, that's also the United States. Job loss in the United States supports lowering interest rates. Now, this is a really cool chart. So all the analysts are predicting, I guess you could use the word predicting, that we're going to have a really good last quarter of the year. And there's earnings seasons just kicked off this week. In October, it's going to last most of the next 2 weeks. And all the analysts are saying that these are going to be great results. They're all expecting great results, all these companies. Let's look at this chart a little bit bigger. This is the seasonals favoring a strong Q4. You can see the S&P 500. This is really important. Watch this. The S&P 500 Q4 path when the Q3 is at least 7.8% growth. So here we are in the bottom left-hand corner of the screen, 2025. If we're saying that the Q4 path goes up historically when we have a Q3 growth of equal to or greater than 7.8, which we did, this is the path that they're predicting for the S&P 500. So it tends to suggest that there's actually more legs to the market, at least for the rest of the year. I'm going to get into the 2026, because 2026, at least in Canada, tends to look not as favorable, and I'll explain that later on. So for those of you who are feeling bullish about the market and feeling like you should be using this wave, well, there's some evidence based on what analysts are saying is that we should have a strong last quarter of the year. For those of you who do not have the stomach for this, there's no wrong answer here by getting out of the market and waiting if you think things are overblown. There's no wrong answer here. We've made a lot of money in 2025 so far. There's no shame in taking your profits right now. I would never argue against that right now. Now, interest rate drops. Are we expecting interest rate drops in Canada and the United States? Yes, absolutely. They are begging in the United States. They're just not begging. They're banging with a drum to have Powell lower interest rates. There are 2 more dates of when they can do this. This is in October, the end of this month, and December the 10th. This is when we're going to find out if rates are going to be lowered. The sentiment is 100% in the United States. I don't know if it's 100. I don't think it's 100% in Canada, but there is this sentiment that we're going to have lower interest rates at least one more time in Canada, possibly 2 more times in the United States. Then again, at the beginning of the year, the sentiment is there'll be an interest rate reduction in Canada. I'm of the mind, this is my belief, that we are going to see interest rate increases in the fall of 2026. And part of the reason for that is the mortgage problem that we have in Canada. So let's talk about some of that. But let's talk about, why do markets just go up? Here's some a little bit of education here. When you have higher interest rates, you have lower corporate profits. Why? Because it costs companies more money to borrow. There's less demand for equities. Why? Because when interest rates are going up, the bond market, fixed income, is more favorable, so people will rotate out of equities and into the bond market, right? And that movement out of equities drives equities lower. But right now we're going into lowering interest rates. So what is that going to do? Raise corporate profit, because companies are going to have lower borrowing costs. They're going to be, with lowering interest rates, that means there'll be a rotation the other way, right? So out of the fixed income products and into equities. That's going to drive equity prices higher. So interest rates have this sort of inverse relationship. When interest rates are dropping, asset price go up, not just in the stock market, but also in real estate. So it's going to be good for real estate prices, especially here in Canada. We saw real estate prices dropping. Hopefully that's going to raise the prices in Canada. Much of the problem with interest rates and real estate prices in Canada have everything to do with the oversupply that we have right now, especially in the condo market. So there's some areas that are kind of grinding against just the fact that interest rates are going down, may not support immediate increases in real estate because of the supply. We've got just a lot of condos sitting empty right now. I think it's something like 50,000 condos, right? So that's a lot of years, probably 4 to 5 years of inventory to go through. Okay, so now what is different between the year 2000, when we had this big tech bubble burst? And I remember working there. I was at Nesbitt Burns at the time, and it was just, well, you could throw a dart at the wall and you were making money, and then all of a sudden, bang, it just bursted overnight and people were freaking out. It was on a level close to the 2008. I think 2008 people were thinking the world was ending. That was a worldwide financial crisis, but things are different. So let's show you what's going on. This is a big graph, long timeline of 2000 that we're comparing to right now. Look at the NASDAQ, right? So that purple graph on the far left-hand side, you see that spike. That's the tech, that's the NASDAQ going up dramatically and falling off of a cliff dramatically. That was scared a whole lot of people. A lot of money was won and lost in a very short period of time here. But now we look over the right-hand side and we see the left side of the pyramid, essentially. If you look at the tech bubble and the run-up, that's what we see right now. We see this run-up on the tech stocks, and that's what you're all worried about. Is it going to repeat 2000? So let's have a look at what is the difference. And I'm just going to blow this up a little bit so you can see. I just want you to see like the severity of the market going straight up in 2000 and then falling off of a cliff. And so it's pretty wild. Now, what I'm bringing this up for is because some of you are at different timelines in terms of your life, right? Some of you are in retirement and this is scaring the heck out of you. Those of you who are younger are like, this is a great opportunity, let's go. So it really depends on your timeline. But right there, what I've just highlighted is something called the lost decade. It took about 10 years for the market to recover. So whatever your balance was in like 2000, all the way out to 2008, it took that long for your money to recover. That was devastating. If you're retired right now, you remember that, and that's why you're worried right now. You do not have 10 years. That's either half or a third of your retirement years. You do not have time to wait. That would be very detrimental to your portfolio, right? I'm going to get into how to protect yourself in the video. Followed after the 2008, just when people were like, finally the market is back up again, bang, we get hit with the worldwide financial crisis. That took about 5 years to recover from that. Again, so now we're looking at about 15 years of people who just didn't recover from that initial downturn in 2000. That is a long time for people to be like thinking, how are we supposed to win here? How are we supposed to save for retirement? I heard all that story a long time ago, and it's relative now because now the market is going up, but the prices of things have gone up dramatically. So it's the same but kind of different, but the story is the same way. People are still trying to figure out how can they afford to retire if the costs of things are going up faster than they can actually earn money. Okay, let's get into what is different now than compared to 2000. So revenue. In 2000, people came out with these grandiose ideas. We're going to create this company. It's going to do this. It's going to be so awesome for everybody. And we believe we're going to make this amount of money on future earnings. Now, the company didn't actually exist yet. They didn't have any clients. They didn't even have any operation of the business. There was no earnings. It was just a bunch of dreaming, really. And people went for it. People were like, that's a great company to invest in. And they dropped their money on that. And that went on for a while, and that just went, as you saw, went straight up. And then it came time to say, okay, enough of the talking, show us the money. And none of these companies there were a few that turned out to be good companies, but most of them didn't. And so there was a lot of people that lost their wealth. What's different this time is these companies are actual companies, have client bases, have long histories of revenue, of earnings. And right now, AI is about $100 billion revenue for these companies. You can see how that's steadily been increasing over time. So a very different situation is now we can actually say, hey, are you actually using this technology in your business? What does it look like? Or is this just a bunch of talking? No, these companies are actually using AI. Right now, the spending. Now, because companies are using AI, seeing the benefit of AI, and extrapolating that and saying, look at where we could be going and thinking about the direction of AI, they see how this is really important, and they're just pouring trillions of dollars into AI. By 2026, $2 trillion of annual spending on AI. So you're telling me that companies, we're talking about the Magnificent Seven companies, right? But there are more than just that are using AI. If they're pouring this amount of money into AI, they not only hope, they have an absolute business model that says it's going to pay off for them. So I would not discount the idea that the market is running up right now because they see what's actually going to evolve through AI and the amount of money they're pouring into it. So I don't think, it's my belief that while prices for technology stocks are higher, I don't think they're at a point where we're at this inflection point where it's about to burst. There's still some room, but then you're going to have to, I think in the 2026, start to say, okay, what is my exposure to AI? What's my exposure to technology? It's going to be a huge boom for manufacturing. About a $4 trillion by 2035. You can see manufacturing is going to be booming. What I'm thrilled about is professional services is the second highest winner out of AI. That's awesome. So I'm looking forward to that. But you can see here, AI is going to really just change the way we live and work. We see unemployment rates going up in part due to AI because it's replacing a lot of jobs right now. And permanently. Now, there's going to be about 100 million people that are needed in 2025 to work in AI. So while some of those old jobs are going away, new jobs are being replaced, but they're in a technology. So I think about it from a point of view of just old legacy kind of businesses that aren't evolving with AI. Those are going to die out. It's no different from the horse to the car to the typewriter to the computer. This is just another time in our life where technology is advancing dramatically, and companies' old ways of doing things are going to be left behind. It's just that simple. Okay, now you don't think this is actually happening? Look at Netflix right now. Netflix is earning $1 billion in revenue every year off of AI analyzing your choices of what kind of movies you watch and what you like, what you don't like, and it's making recommendations to you about what you should be watching based on based on the things you enjoy. And that's producing about $1 billion of revenue just for Netflix. It's actually happening. So what's different about 2000 and now is there's revenue behind this. There's actually technology behind it that's being implemented in these companies. So it's a significant difference. I mean, it's night and day over what happened in 2000. So what are my areas of concern? There are really two areas. And how am I doing, by the way? You like this content? I went into a lot of research to get this to you, so I hope you like it. Smash that subscribe button and like button. Put your comments. I like hearing your comments. Let's go into the two concerns that I have. Okay, the first one, it's not a concern, but it's somebody else that has a concern. Somebody else is a whole lot better at markets and investing than I think anybody in the whole world. Warren Buffett. So there's this thing called the Buffett indicator. And so based on this, where are we now with the Buffett indicator? He comes up with this formula. It says you take the total market capitalization of the stock market and you divide it by the gross domestic product of the country. And that's going to tell us where we are we inflated or not? There's the chart. And we're at 217%, but you go, okay, well, so what does that mean in terms of, is that good or is that bad? Here is actually the index. We are 68% above the historical trend line. So this suggests that markets, the prices of stocks are way above than they should be, and they're overvalued. And that may cause some concern for you as it is for everybody else. The question is, do you still think that there's some room for this to advance before things get out of control? So Warren Buffett went on to say, if the percentage relationship falls to 70 or 80%, it's a great time for you to buy stocks. But if it goes above 200% like it did in 1999 and 2000, you're playing with fire, he says. For 11 consecutive quarters, that's a long time, Berkshire Hathaway has been selling more of their stocks than buying. This is the first time in the history of their company that they're doing this. And they're now sitting on $347 billion in cash. What do you think? You think this guy, the most successful investor of all time, might know something more about the markets than we do? It's worth paying attention to, I think. So I would lean more heavily on the idea that if you feel like the market you've made money and you have you're hedging your bet that it could reverse and then you get stuck, then start to change the allocation in your portfolios. I'm not saying go to cash, but certainly just change the weighting of your portfolios. I'm going to get into a little bit of that in a minute or so. Okay, so the first area that I'm concerned about is the Canadian budget. That's going to be on November the 4th. And here is what they're saying. This is the government. Here's what they're saying so far. Prime Minister Carney said this is going to be in the fall, and it's going to be austerity and investment-focused budget. I like the way that they say austerity, but it's going to be, hey, we're going to spend a lot of money to improve your life. And they are expecting to run higher deficits. Also, what's going to come out is that they're going to tell us that our deficit is much larger than what we were led on to believe. And those two things of running high deficits, this word austerity, usually means we have to hold on to our cash, watch our spending. Those two messages, my belief, is going to drive the Canadian market negative. At least, let's say, sideways. But my feeling is that we're going to go negative. For how long? Maybe it's a month, maybe it's 3 months. But I just know that following that announcement, as we roll into 2026, we have $1.9 million or 1.9 million homes renewing their mortgages. And they're going from sub 2% in many cases to 4.25%. This is going to be devastating. We've already seen power of sale rising in Canada, mostly in the secondary markets with private lending. So these are private lenders foreclosing on people who needed cash to buy their rental properties, right? And my belief is we're going to see this is going to just, amplify. It's going to be greater in 2026. So my worry is we're going to come in with a budget that's going to be highly deficit oriented, and then asking to figure out ways to do cutbacks, use this austerity language, and then big loan loss provisions by the banks. I'm just worried that 2026 is going to be not as great as 2025. I can't see it being better than 2025. I see it being less than 2025, which means you need to change how you're weighting both US equities and Canadian equities, and pick what kind of equities. Maybe you want less technology exposure. Maybe you want to have less exposure to the banks if you feel like they're going to be having pressure with loan loss provisions. So there's some areas where you need to think very clearly about your weighting of stocks in Canada and in the US, and what kind of stocks, okay? So that's my concern for Canada. And so what does this really translate in terms of what I believe the government's going to do? So my belief is the Canadian stock market is going to decline in 2026, maybe by probably the first quarter, we're going to start seeing declines in the market. Certainly in November, we're going to see declines in the Canadian. Like, if I'm wrong about this, I'll have to come back on and do a video saying I was wrong. But my belief is that the Canadian stock market is going to go negative on the day of the announcement. Like, hold on to your shirt. I think it's going to be not good news for the Canadian stock market. So what will the Canadian government need to do? They're going to need to raise revenue, right, in order to pay for all of the spending they're going to do. This is going to come through from the form of two ways: tax and do cutbacks. So where are they going to tax? There's a possibility they could increase GST. By the way, Carney already said that he's not going to increase the inclusion rate on capital gains. He already said that pre-election. I tend to believe that he's actually not going to do that, or that he won't raise the inclusion rate. But in other areas, increase GST. The thing that we all thought should go away, I think we're going to see an increase to that. Increase the general tax rate on people, especially in the high income tax bracket. They could introduce a wealth tax or an estate tax. Now, in Australia, they introduced a bill that has basically a tax on unrealized capital gains. So if you've got assets that have gone up in value, they're going to tax in Australia on unrealized gains. Now, there's a threshold that they've attached. I think it's 3 million. So if it's gone above that, then you get taxed. Is it something that could happen here in Canada? Absolutely. I don't think that's something that I think it's something they would entertain. Would they start taxing our estates differently? Yes, I see them doing that. And wealth tax for people who are buying luxury cars. There's already a wealth tax on luxury cars. And for the people that are earning more and buying more luxury goods, I can see a tax being applied more broadly on that as well. Okay, increased corporate tax rate. Absolutely, I can see that happening. Now, the government has already said in July, told their ministers that we want you to find operational savings of between 7.5% from 2026 to 27, then 10% from 27 to 28, and then 15% of operational savings 28, 29. I mean, that's doubling the cutbacks between now and 28 and 29. Now, you would hope that they're doing the cutbacks in areas of the government we all believe, I'm not going to get into now, too political, about where we don't like to see money being sent, especially out of our country. Now, does this mean that they're going to cut back services? Maybe. That's the situation. I don't think it's going to be let's cut back on pencils and paper clips, but I think it could be in the area of services that we'll see cutbacks. Okay, that is the one area of concern, and that's Canada. The other area of concern is tariffs in the United States. Okay, this is a little bit more, it's not complex, but it just means what's going to happen to the U.S. economy if this happened. So for those of you who aren't aware, President Trump, if you've been living in Iraq and you weren't aware and didn't watch the news, President Trump implemented some tariffs, and he's being sued, or his government is being sued, and it's going to the Supreme Court. That is being heard in the early part of November. It's being fast-tracked. So how did this happen? In April, President Trump, he declared a national emergency, and he assumed the powers under the Emergencies Act to be able to implement tariffs. Now, the whole problem with this, I'll spend a minute or two just to tell you what this is all about. It's not that I'm for or against it, I'm just giving you some of the background, okay? So, if a lower court judge said these tariffs are illegal, and so it's now being sent to the Supreme Court to figure out are they illegal or not. Now, if it is the decision of the Supreme Court that it is illegal, then do they have to pay back tariffs to all these countries and companies, or not countries, but companies that invested in the United States? Quite possibly. So where's the background for this? In 1971, there's a precedent by Richard Nixon, the then president of the United States, when basically in the United States, the gold standard was failing. And Nixon needed to do something to save the economy of the United States. And he implemented something under the, I'm going to read it because I've never even heard about this, the Trading with the Enemy Act. There's an actual act that was created in the United States. And so it allows a president, in this instance, to raise tariffs by 15%, but not longer than 5 months. And so Trump is using this as this is what he's is basing his whole argument on. Now, the whole thing, though, is that this was supposed to be a temporary measure and only 15%. Trump's tariffs are much higher than that and seem to be going on longer than that. And so it's kind of wonky, right? In terms of he's playing it pretty loose. And so the question is, the first part of the question is, the president of the United States doesn't have the right to create an executive order and just tariff businesses and countries. It doesn't fall under it. There's no language around that. And so the whole argument is the only way a president gets these rights are through Congress. They're given to the president, and then the president does it. So back when Nixon did it, he didn't have the right to do it as well. And so he implemented this. Then his government was sued. The Congress quickly passed the law to allow him to do it. So then it's kind of like, okay, so he can do it. Then he was sued. By the time it went to court, the tariffs it was only on for 5 months. The tariffs had all expired. And so there was really well, what do you want to argue about? So what they were arguing about is, should the government have to repay the tariffs if the tariffs weren't supposed to be allowed until the government gave them permission to do that? That is the whole point to this argument that's happening for Trump right now. Now, the other thing you should know is who is bringing the suit? Well, there's two parties, really. There's a collection of 5 small businesses that are claiming that their businesses will go under if these tariffs continue because they can't afford to pay the tariffs. And the other group that is coming to this suit are 12 Democratic Attorney General of the United States bringing this suit together. And there are no Republican Attorneys General. It's just 12 Democrat Attorneys General. So it is incredibly politically motivated. This is the way the U.S. is going right now. It's going for how many presidents? It's all politically driven. So it's really difficult to see where we're going to end up in November. But do you remember this chart that I showed you where the trend line of going up in the United States, but there was a dive down in November? This is one of the reasons why, right? Is that there's a potential for the Trump administration to lose on this decision, repay back the tariffs, but That doesn't stop AI from thriving. That's not going to change anything. Those companies are still going to pour a lot of money into their AI. That's going to drive the technology market higher. So it's just going to be a temporary, very uncomfortable, very unnerving if it happens. Pay attention. Remember this. You're going to see the markets go sour in the United States, and it's going to be ugly for a short period of time until they can figure out what to do. But the AI market is going to continue to thrive and go forward. Okay, glad you stuck around to this video. This is a long one, but you know what? It was worthwhile for me to share with you what is going on and what you should do. So the bottom line for you is, if you don't have the stomach for markets rising beyond what they already are now, then be comforted by the fact that you made some really great gains. Take those profits, reinvest them in the market into maybe some lower volatile equities that don't move so dramatically, that aren't related to tech stocks. Go into fixed income, even though those things are not going to produce the kind of returns that you're going to have loved in 2025, but you're also not going to experience minus 25 in those kinds of investments as well. And wait for the market to kind of go into a new cycle, if you will, because we're going to experience a new cycle in 2026, and then begin to reinvest your money that way. You can also pay attention to this video up here that I did where I talked about, you know, the 3-bucket strategy, or the 25-75 strategy that would be helpful for you. You know, if you got a lot of money, you can do the 25-75 where you put 25% of your money in cash, ladder GICs if you like, and that frees you to have 5 years of money in cash that would certainly outlast any volatility in the market. And that frees you up to put 75% of your money very long into positions, knowing that those things might go down temporarily, but long-term pay off for you. So pay attention to those videos up there. Hey, it was great to see you in this video. I have this question for you. What scares you the most about the market? Or do you think it's a great opportunity right now? Put your comments below. I love reading your comments. Great to see you again. I look forward to seeing you in the next video. Thanks, and be well.